Hello, investors, and welcome to Market Pulse from Stock AI Insights. I'm your chief AI analyst, so let's just get right to it. The question that is on everyone's mind. Is this massive AI boom a real revolution, or are we staring at a bubble that's about to pop? Today, we're going to dig into a really critical Goldman Sachs analysis, which was highlighted in Fortune, to see if we can find some answers.
And just a quick reminder before we dive in, this is all for educational reference only. It is not investment advice. You know the drill, investing always involves risk, so please do your own research.
Okay, so to really get our heads around this, we first have to talk about the sheer scale of this boom. The numbers are frankly staggering, and they all point to one single multi-trillion-dollar question.
$19 trillion. No, that is not a typo. Since ChatGPT launched, that is the insane amount of market value that's been tacked onto AI-related companies. I mean, to put that into perspective for you, that's more than the entire annual GDP of China. It's a surge in value that is, well, almost unheard of. Which, of course, brings us right here to the heart of the debate. Is this whole run-up just a speculative bubble, fueled by hype and FOMO, or is it a totally justified boom that's correctly pricing in a technology that is literally going to reshape our world? This is the question we have to get to the bottom of.
To get some real answers, we're turning to Goldman Sachs. They actually call this the most important question facing the entire US stock market right now. So let's follow their logic, step by step, and see what the data is really telling us. All right, so to separate the real potential from all the hype, Goldman started by doing the hard work. They calculated the actual, tangible, economic value that AI could create. And this is where we get into their macro math.
Now, they use a core financial concept called present discounted value, or PDV. Don't worry about the jargon. It's actually way simpler than it sounds. All it really does is ask a simple question. If AI is going to make a whole ton of money over the next, say, 10 years, what is all that future cash worth in today's dollars? It's a way to ground all these futuristic dreams in cold, hard, present-day reality.
So after they ran all the numbers, what did they come up with? Well, their baseline estimate for the real economic value that AI will likely create comes out to $8 trillion. Now remember that number, 8 trillion. It's pretty much the anchor for this entire analysis.
Of course, forecasting the future is never a perfect science, so Goldman gave us a plausible range. On the low end, a more cautious guess is 5 trillion. Their high end, the everything goes absolutely perfectly scenario, that lands at 19 trillion. Keep that high-end number in your back pocket. It's about to become really important.
And this brings us right to the core of it all. We have the fundamental economic calculation. Now let's stack that up against what's actually happening in the stock market, because, well, this is where we find a pretty big disconnect.
I mean, just look at this chart. It really says it all. On the left, you've got Goldman's baseline, that $8 trillion projection for real economic benefit. And on the right, that's the $19 trillion the market has already added. The takeaway here is just stunning. The market isn't just pricing in the likely outcome, it is already priced in the absolute best-case pie-in-the-sky scenario as if it's a done deal.
In Goldman's own words, the market pricing is running well ahead of the macro impact. This is really the central finding of their whole report. Investor enthusiasm has just gotten way out over its skis, far ahead of the fundamental economic reality, at least for now.
So, with the market this far ahead, the next logical question is, have we seen this movie before? And history's answer is a big yes. Goldman actually draws some really crucial parallels to other huge innovation booms from the past.
Goldman points to two specific psychological traps that investors tend to fall into during times like these. The first one is called the Fallacy of Aggregation. This is basically when we assume every single company with AI in its name can be a massive winner, but we forget they're all fighting for the same piece of the pie. The second is the Fallacy of Extrapolation. That's when we see this initial explosive growth and just assume it's going to go on forever, totally forgetting that intense competition always comes along and eats away at those huge profits. And this quote really puts it all into historical context. Just think about the 1920s with the automobile and the radio, or the 1990s with the internet. In both of those cases, the technological revolution was 100% real, but that didn't stop the market from getting completely swept up in the hype and just massively overpaying for future profits.
So, after weighing the fundamentals, the market frenzy, and all these lessons from history,
What is our pulse verdict? Let's break down Goldman's final, nuanced take on all of this.
What's so interesting here is that their conclusion isn't a simple, it's a bubble or it's not. They're saying that yes, valuations are definitely high, but they aren't quite at those classic crazy bubble levels we saw back in 2000, at least not yet. But they are very clear that the market's view right now is excessively optimistic. And yet, and this is a huge yet, they totally affirm that the underlying promise of AI is incredibly powerful and very, very real.
And let's be clear, that long-term promise is enormous. Goldman's model suggests AI could add a full 1.5 percentage points to U.S. productivity growth every single year for a decade. For modern economy, that is a gigantic boost. Over time, that could lift the entire U.S. GDP by something like 15%. The long-term prize here is absolutely the real deal.
The immediate danger, though, is this huge gap between that future promise and today's reality. Right now, if you look outside the hardware companies, the ones selling the picks and shovels in this AI gold rush, the actual tangible profits are still pretty hard to find. That $19 trillion valuation is basically a giant bet that massive profits are going to show up very, very soon to justify these prices.
You know, maybe the best way to think about this whole situation is with a simple race metaphor. The real economic impact of AI, that's a marathon. It's a long, steady race that's going to play out over the next 10 years. The stock market, on the other hand, it's running a 100-meter dash. It has sprinted ahead at full speed and is already standing at the finish line, tapping its foot, waiting for the marathon runner to instantly catch up.
So our final market pulse verdict is this. The AI revolution is real. Its potential is absolutely undeniable. But market history teaches us a very clear lesson. Extreme caution is probably a good idea when enthusiasm gets this hot, this fast. And that really leaves us with a final question for every single investor watching. When the market excitement is running this far ahead of the economic reality, how do you, personally, separate the true long-term signal from all of the short-term speculative noise?
And that's our market pulse for today. What are your thoughts on Goldman's analysis? Do you agree? Disagree? Let me know down in the comments. Thanks so much for watching, and I will see you for the next breakdown.